Chapter 3. Financial Analysis and Planning. Ratio Analysis. Financial Statements Analysis. Draw meaningful interpretation of financial statements for parties demanding financial information. Financial statements are usually defined as statements that contains financial information. Various parties interested in financial statement analysis management, analyzing the overall strengths and weaknesses of the company. They can plan for future. They is interested in evolving analytical tools that will measure costs, operational efficiency, liquidity and profitability with the objective of taking appropriate decisions. Investors, they are primarily interested in earning capacity, liquidity and financial risk of the company. They calculate profitability ratios, liquidity ratios and capital structure ratios. These ratios determine whether investors can earn regular and growing returns. Trade creditors primarily concerned with short-term liquidity position of the company since their claim fall due only in short term. They generally calculate liquidity ratios like current ratio, quick ratio, etc. Long-term lenders like banks, financial institutions, etc. analyze the ability of the company to serve and redeem the debt within a specified period. They want to know the long-term profitability and cash flow position of the company. They calculate capital structure leverage ratios and profitability ratios. Customers, they want to assess the business viability of the company before entering into long-term contract with the company. Types of financial statement analysis. Internal analysis. This analysis is done by company's own management. External analysis. This analysis can be done by any outside parties like creditors, banks, etc. Horizontal analysis. This analysis involves comparison of financial data of different years. Example: comparison between gross profit ratio for last 2 financial years. Vertical analysis. This involves study of relationship between different items of financial statements for one particular year. Example: calculating gross profit to sales ratio for the year. Financial ratio analysis. Financial ratios measures relationship expressed in mathematical terms between figures which are connected with each other in significant manner. Process of determining, interpreting and presenting numerical relationships of items and group of items in the financial statements. Ratios are presented in the following forms as rates which refer to ratios over a period of time: quotient, percent. Process of ratio analysis. 1. Establishing the purpose of financial analysis. 2. Working of ratios. 3. Interpretation of ratios. 4. Remedial actions on variance with the objective of improvement in efficiency. Financial ratios for evaluating performance. A. Liquidity position. Can draw conclusions regarding liquidity position of a firm. It's satisfactory if it is able to meet its current obligations when they become due. A firm can be said to have the ability to meet its short-term liabilities if it has sufficient liquid funds to pay the interest on its short-maturing debt, usually within a year, as well the principal. This ability is reflected in the liquidity ratios of a firm. Liquidity ratios are current ratio, liquid ratio and cash to current liability ratio. The liquidity ratios are particularly useful in credit analysis by banks and other suppliers of short-term loans. B. Long-term solvency ratio analysis is equally useful for assessing the long-term financial viability of a firm. This aspect of the financial position of a borrower is of concern to the long-term creditors, security analysts and the present and potential owners of a business. It measured by the leverage, capital structure and profitability ratios which focus on earning power and operating efficiency. Ratio analysis reveals the strengths and weaknesses of a firm in this respect. The leverage ratios, for instance, will indicate whether a firm has a reasonable proportion of various sources of finance or whether heavily loaded with debt, in which case its solvency is exposed to serious strain. The various profitability ratios would reveal whether the firm is able to offer adequate return to its owners consistent with the risk involved. C. Operating efficiency. Ratio analysis throws light on the degree of efficiency in the management and utilization of its assets. The various activity ratios, such as turnover ratios, measure this kind of operational efficiency. These ratios are employed to evaluate the efficiency with which the firm manages and utilizes its assets. These ratios usually indicate the frequency of sales with respect to its assets. These assets may be capital assets or working capital or average inventory. The solvency of a firm is, in the ultimate analysis, dependent upon the sales revenues generated by use of its assets, total as well as its components. D. Overall profitability. The outside parties which are interested in one aspect of the financial position of a firm, the management is constantly concerned about the overall profitability of the enterprise. That is, they are concerned about the ability of the firm to meet its short-term as well as long-term obligations to its creditors, to ensure a reasonable return to its owners and secure optimum utilization of the assets of the firm. This is possible if an integrated view is taken and all the ratios are considered together. E. Inter-firm comparison. Ratio analysis not only throws light on the financial position of a firm but also serves as a stepping stone to remedial measures. This is made possible due to inter-firm comparison with industry averages. A single figure of ratio is meaningless unless it is related to some standard or norm. One of the popular techniques is to compare the ratios of a firm with the industry average. It should be reasonably expected that the performance of a firm should be in broad conformity with that of the industry to which it belongs. An inter-firm comparison would demonstrate the relative position vis-à-vis its competitors. If the results are at variance, either with the industry average or with those of the competitors, the firm can seek to identify the probable reasons and, in the light, take remedial measures. Ratios not only perform post-mortem of operations, but also serve as barometer for future F. Financial ratios for budgeting. In this field, ratios can provide a great deal of assistance. Budget is only an estimate of future activity based on past experience, in the making of which the relationship between different spheres of activities are invaluable. Ratios are very helpful in forecasting and planning the business activities for a future. It helps in budgeting. It is usually possible to estimate budgeted figures using financial ratios. Ratios also can be made use of for measuring actual performance with budgeted estimates. They indicate directions in which adjustments should be made either in the budget or in performance to bring them closer to each other. Classification of ratios. Classification according to the statement from which ratios are derived. 1. Balance sheet ratios. Both the items of ratio are taken from balance sheet, e.g., debt-equity ratio. 2. Revenue statement ratios. Both the items of ratio are derived from profit and loss account, e.g., gross profit ratio. 3. Interstatement or combined ratios, where the items are taken from different sources, e.g., return on capital employed. Classification. According to importance: 1. Primary ratios, more important. 2. Secondary ratios, less important. Functional classification: 1. Cash position ratios. 2. Liquidity ratios. 3. Working capital ratios. 4. Capital structure ratios. 5. Profitability ratios. 6. Debt service coverage ratios. 7. Turnover ratios. Cash position ratios, needs for meeting its daily operating expenses and other obligations. Higher ratio indicates better liquidity position. A very high ratio is not desirable, since excess cash earns nothing. 1. Absolute cash ratio equals cash marketable securities divided by current liabilities, strictest measure of liquidity. Indication of ready cash available to meet current liabilities. 2. Cash to total assets ratio equals cash marketable securities divided by total assets. Indication of composition of cash availability in total investment. 3. Interval measures equals cash marketable securities divided by average daily cash operating expenses. Indication of time length that can be covered by the available cash to meet operating expenses. Note: marketable securities means the securities, which can be converted into cash at short notice. Quoted investments are not necessarily marketable securities. Liquidity ratios or short-term solvency. Ability of the business to pay its short-term liabilities. Inability to pay off short-term liabilities affects its creditability as well as its credit rating. Cash position ratios may be supplemented for liquidity appraisal. Ratio differs from industry to industry as well as with policy. Higher the ratio, better the coverage. 1. Current ratio, working capital. Solvency ratio equals current assets divided by current liabilities. Indication of availability of current assets to pay off current liabilities. Higher the ratio, better the coverage. But a high ratio may be due to slow-moving inventory, inefficient debt collections, idle cash, etc. So, this ratio may be cautiously analyzed. 2-to-1 ratio is treated as standard ratio. Current ratio less than 1 means negative working capital or an aggressive financing policy which may be risky. 2. Liquid ratio or quick ratio or acid test ratio equals quick assets divided by current liabilities. OR equals quick assets divided by quick liabilities. Indication of availability of quick assets to honor its immediate claims. A fairly strict measure of liquidity as compared to current assets. It excludes those assets which have either slow or no cash realization, e.g., stock and prepaid expenses. 1-to-1 ratio is treated as standard ratio. Note: current assets equals inventories. Trade receivables, cash and bank balances, marketable securities, advances to material suppliers. Prepaid expenses, advance income tax, in excess of provision. Current liabilities equals trade creditors for services, short-term loans, bank overdraft, cash credit outstanding. Expenses, provision for taxation, net of advance tax, proposed dividend unclaimed. Dividend quick assets equals current assets. Inventories, prepaid expenses, quick liabilities equals current liabilities. Bank overdraft, cash credit from bank, cash credit, bank overdraft. Working capital, cash flow ratios. Cash generation ability of business is necessary to be judged and measured to judge the performance. Cash from operations is based on cash concept, i.e. net operational cash receipts, indication for cash generated for every re. 1. Sale. Higher the ratio, better the performance. 1. Cash generated from operation to sales ratio equals cash generated from operation divided by sales. 2. Cash generated from operation to total assets ratio equals cash generated from operation divided by total assets, average, capital structure ratios, long-term solvency ratios, leverage ratios. Insight into financial techniques used by business and focus on the long-term solvency position. 1. Owner's equity to total equity ratio equals owner equity divided by total equity, indication of proportion of owner's funds to total funds invested in the business. Higher the proportion of owner's fund, lower is the degree of risk. 2. Debt equity ratio equals long-term divided by debt shareholders' equity. The ratio is useful for deciding upon the capital structure. Lenders judge the standard borrowing capacity by normally considering the ratio as 2:1. Indicator of financial leverage. 3. Capital gearing ratio equals long-term debt. Debenture preference share capital divided by equity share capital reserves and surplus, losses and fictitious assets. The ratio is useful to show the proportion of fixed interest, dividend bearing capital to funds belonging to equity shareholders. Higher the ratio, higher the risk. The ratio is complementary to financial leverage. 4. Fixed assets to long-term fund ratio equals fixed assets divided by long-term fund. Fixed assets and core working capital are to be covered by long-term funds. There is no uniform standard ratio due to change in composition of fixed assets and current assets. The ratio should be less than 1. If it is more than 1, it means short-term funds have been used to finance fixed assets. It means a very risky aggressive approach has been followed. 5. Proprietary ratio equals proprietary funds divided by total assets. The ratio indicates proprietor's stake in total assets. It shows the limit up to which the shareholders own the business. Higher the ratio, lower the risk, but profits won't be maximized. The ratio is like owner's equity to total equity, capital structure ratio, debt equity ratio and current ratio affects the proprietary ratio. 6. Net working capital ratio equals net working capital divided by capital employed. This ratio shows the level of current assets being financed by long-term funds. Note: owner's equity, shareholders' equity equals share capital, equity preference, reserves and surplus, loss. Proprietary funds equals equity share capital preference share capital reserves and surplus, losses and fictitious assets. Preference share capital is included in equity. When the ratio is being calculated to ascertain financial risk, e.g., debt equity ratio, preference share capital is included in debt. When the ratio is being calculated to show the effective use of fixed charge funds on earnings available to shareholders, e.g., fixed charges, coverage ratio, capital gearing ratio, etc. All secured and unsecured loans are treated as long-term liability unless otherwise mentioned. Any long-term debt maturing in current year is included in current liabilities. Net fixed assets refer to fixed assets less depreciation. In all the ratios, we should use net fixed assets only. From the point of view of debt providers, there should be low debt-equity ratio and high proprietary ratio. Proprietary ratio total debts to total assets ratio equals 1. 1 fixed asset divided by capital employed equals working capital divided by capital employed, assuming no non-trading investment by firm. Profitability ratios. Indicator of overall efficiency. Higher ratio indicates better efficiency in utilization of long-term funds. 1. Return on investment, ROI, equals returns or earnings divided by investment, times 100 OR equals net profit to sales ratio x capital turnover ratio. 2. Return on capital employed, ROCE, equals EBIT divided by capital employed, times 103. Return on equity, ROE, equals profit after tax divided by net worth equals profit after tax, preference dividend, divided by net worth. 4. Return on assets, ROA, equals net profit after tax divided by average total asset OR equals net profit after tax divided by average tangible asset OR equals net profit after tax divided by average fixed asset OR. Other profitability ratios. 5. Gross profit ratio equals gross profit divided by sales, times 100. A high ratio may be due to low cost or high sales price. Change in price levels or efficiency affects the ratio. 6. P/V ratio equals sales, variable cost, divided by sales, times 100 equals contribution divided by sales, times 100. Higher P/V ratio lowers break-even point, fixed cost remaining the same. Higher P/V ratio leads to increase in ROI with increase in sales. 7. Net profit ratio or operating profit ratio equals net operating profit divided by sales, times 100, indication of net margin of profit available on 100 rupees sales, indicator of overall operational efficiency. It shows return available to shareholders. Sales, gross or net, should be interpreted consistently. 8. Individual expenses or group of EXPs to sales ratio equals expenses divided by sales, times 100, useful for reconciling deviation in net profit, useful for forecasting and budgeting. 9. Operating ratio equals operating cost divided by sales, times 100. Lower the ratio, higher is efficiency. Operating cost equals COGS. Other operating expenses. Certain expenses are uncontrollable, so one must concentrate on reducing the controllable expenses. Complementary to net profit or operating profit ratio. A rise or fall in operating ratio affects the operating profit. It gives a useful insight about the reasons for a change in profit from year to year or from one firm to another. Operating ratio equals 100. Operating profit ratio. 10. Earnings per share, EPS, equals share a same paid up equals earnings available to equity share holder divided by number of equity shareholder shares. A different paid up equals earnings available to equity shareholder divided by number of equivalent equity shareholder. 11. Price earnings ratio equals average or closing equity share market price divided by EPS. Note: capital employed equals equity share capital, preference share capital, reserves and surplus debentures and other long-term loans, miscellaneous expenditure and losses, non-trade investments, Intangible assets should be included in the capital employed. No fictitious assets should be indicated. It is more appropriate to work out the ratio based on average capital employed during the year. ROI may be calculated on the basis of shareholders' capital employed. Net profit to sales ratio equals net profit divided by sales. Capital turnover ratio equals sales divided by capital employed. Return on equity measures the profitability of equity funds invested in the firm. This ratio reveals how profitability of the owner's funds have been utilized by the firm. Earning available to equity. Shareholder equals PAT, preference dividend, tax on preference dividend, market value of share. Equals EPS times price earning ratio debt service coverage ratio judge firm's ability to pay off current interest and installments. Higher the ratio, more security to the lender. 1. Debt service coverage ratio or debt service ratio equals earnings available for debt service divided by interest on term loans. Term loan installments ratio of 1.6 is treated by financial institutions as satisfactory ratio. Financial institutions lend money even with lower debt service ratio in case of core infrastructural projects. 2. Interest coverage ratio * or times interest earned ratio equals earnings before interest on term loan and taxation. OR equals earnings before interest on term loan but after taxation divided by interest on term loans. The ratio indicates adequacy of profit to cover interest. It should be at least greater than 1. A too high ratio would indicate underutilization of debt capacity. This ratio does not cover principal repayment obligations. Note: earnings available for debt service equals net profit after taxation. Non-cash operating expenses like depreciation and other amortizations. Non-operating adjustments. Interest on long-term loans. DuPont control chart. Change in any of these ratios will change the firm's earning power. These two ratios are affected by many factors. A change in any of these factors will change these ratios also. The various factors affecting the ROI can be put through a chart given below. This chart is known as the DuPont control chart since it was first used by DuPont Company of the USA. Show that return on capital employed is affected by several factors. Any change in these factors will affect the return on capital employed. Helps the management in concentrating attention on different forces affecting profit. An increase in profit can be achieved either by more effective use of capital, which will result in a higher turnover ratio, or better sales efforts, which will result in a higher net profit ratio. The same rate of return can be obtained either by a low net profit ratio but a higher turnover ratio, or a low turnover ratio but a high net profit ratio. Components using the DuPont model. 1. Net profit margin. After tax profit a company generates for each rupee of revenue. Net profit margins vary across industries, making it important to compare a potential investment against its competitors. Although the general rule of thumb is that a higher net profit margin is preferable, it is not uncommon for management to purposely lower the net profit margin in a bid to attract higher sales. Net profit margin equals net income revenue TTHE. Lower the margin, the less room for error. A business with 1% margins has no room for flawed execution. Small miscalculations on management's part could lead to tremendous losses with little or no warning. 2. Asset turnover. Measure of how effectively a company converts its assets into sales. It is calculated as follows. asset turnover equals revenue assets. It tends to be inversely related to the net profit margin, i.e., the higher the net profit margin, the lower the asset turnover. The result is that the investor can compare companies using different models, low profit, high volume versus high profit, low volume, and determine which one is the more attractive business. 3. Equity multiplier. It is possible for a company with terrible sales and margins to take on excessive debt and artificially increase its return on equity. The equity multiplier, a measure of financial leverage, allows the investor to see what portion of the return on equity is the result of debt, turnover, activity, performance, efficiency, asset utilization ratios. Higher return on investment depends on higher capital turnover apart from the profit margin per rupee of sales. Higher the ratio, greater is the efficiency and higher the profits. 1. Capital turnover ratio equals sales divided by average capital employed, indicator of utilization of resources. Only closing figures are given. We can use that in the denominator. A low ratio indicates underestimation of capital. 2. Fixed assets turnover ratio equals sales divided by fixed asset, indicator of utilization of fixed assets. Operating efficiency is achieved when the ratio rises due to rise in sales and not when the ratio rises due to low value of fixed assets. Significant change. Take average fixed assets available for use. 3. Working capital turnover ratio equals sales divided by working employed, shows the efficiency with which working capital has been used in generating sales. Significant change. Take average working capital employed. 4. Inventory turnover ratio equals cost of goods sold divided by average inventory. How fast the finished goods have been sold. Stock holding ratio equals average inventory divided by average daily or monthly cost of sales. Average inventory equals opening inventory. Closing inventory divided by 2. COGS is not available. One can use sales also. Too low ratio indicates overstocking or obsolete, non-moving inventory. 5. Raw material inventory turnover ratio equals raw material consumed divided by average raw material stock. 6. Debtors turnover ratio equals net credit sales divided by average account receivables, shows the velocity of conversion of debtors into cash. Very low ratio may indicate very lenient credit terms. Accounts receivable equals sundry debtors bills receivable, bills discounted, endorsed not appearing in the balance sheet requires adjustment. Seasonal variations in sales affects ratio. In that case, scrutinize debtors with age-wise analysis. 7. Debtors collection period equals average account receivable divided by average daily or monthly credit sales. Compare with credit period granted. 8. Creditors turnover ratio equals net credit purchase divided by average account payable. It shows the velocity for payment for credit purchases. If payments are delayed beyond the credit period, it will lose goodwill. If payments are done too early, it will lose interest. Accounts payable equals trade creditors bills payable. The ratio is worked out with the revenue purchases. 9. Creditors payment period equals average account payable divided by average daily or monthly credit purchase. Other ratios. 1. Appropriation ratios equals interest divided by EBIT times 100 OR, tax divided by EBIT times 100, indication of disposal or appropriation of income. These ratios are usually calculated with reference to EBIT2. Dividend payout ratio equals DPS divided by EPS times 100, indication of distribution of profit as percent of earning. 3. Preference dividend coverage ratio equals PAT divided by preference dividend, indication of adequacy of profit to cover dividend on preference shares. 4. Dividend yield equals DPS divided by MPS, indicates return earned by equity investors taking dividend as base for analyzing return. It is useful for the investors in making investment decision. 5. Capitalization rate or earning yield equals EPS divided by MPS, indicates return earned by equity investors taking earning as base for analyzing return. Reciprocal of price-earning ratio. 6. Market value, book value per share, equals average share price divided by net worth, number of equity shares or closing share price divided by net worth. Number of equity shares. This ratio indicates market response of the shareholders. Investment. Undoubtedly, higher the ratios, better is the shareholders' position in terms of return and capital gains. Basic equations: cost of goods sold, COGS, equals opening stock purchases. Direct expenses, closing stock cost of goods sold equals sales. Gross profit sales equals gross profit ratio. Gross profit equals sales x gross profit ratio. COGS ratio. Gross profit ratio equals 100. Gross profit ratio. Operating expenses ratio equals operating profit ratio. Operating expenses ratio. Operating profit ratio equals 100. Net profit equals net profit ratio. X sales. Working capital. Net current assets equals current assets, current liabilities total. Operating costs equals cost of goods sold. Other operating expenses. Raw material consumed equals opening stock of raw material purchases. Closing stock of raw material. Cost of production equals opening stock of WIP raw material consumed. Direct wages. Production expenses. Closing stock of WP. Average daily cash expenditure equals COGS. Cash operating expenses, 365 days. Total of liabilities side equals net worth. Long-term debt. Current liabilities. Total of assets side equals fixed assets. Investments. Current assets. Net worth equals total assets, total debts. Net worth equals fixed assets. Working capital. Long-term debt. Capital employed equals net worth. Long-term debt. Non-trade investments. Capital employed equals fixed assets. Net working capital. Non-trade investments. Common size statements, CSS, prepared by converting the absolute rupee amounts of financial statements into percentages, in the following manner. For profit and loss A.C. sales equals 100% and all items of expenditure are shown as a percentage of sales. For balance sheet, total of B.S. equals 100%. Each asset and liability item are shown as a percent of this total. Profit and loss account indicate the expenditure patterns of the company. In case of the balance sheet, it shows the pattern of asset holding and the extent of liabilities. Common size statements are also prepared over several years in order to analyze the trend, pattern, movement of various items over the years. It also helps in inter-firm comparison. Limitations of financial ratio analysis. 1. Window dressing. Ratios depict the picture of performance at a point of time. 2. Impact of inflation. The return on assets or return on Capital employed may be very high due to less investment in fixed assets. Ratios may not indicate the true position in such situations. 3. Product line diversification. Detailed ratios for different divisions, products and market segments, etc. may not be available to the users in order to make an informed judgment. 4. Impact of seasonal factors. When the operations do not follow a uniform pattern during the financial period, ratios may not indicate the correct situation. 5. Differences in accounting policies. Different firms follow different accounting policies. 6. Lack of standards. Even though some norms can be set for ratios, there is no uniformity as to what an ideal ratio is. Generally, it is said that current ratio should be 2:1. But if a firm supplies mainly to government departments where debt collection period is high, a current ratio of 4:1 or 5:1 may also be considered normal. 7. High or low. A number by itself cannot be high or low. Hence, a ratio by itself cannot become good or bad. The line of difference between good ratio and bad ratio is very thin.